When I started to invest my money into the stock market 10 years ago, I was pretty overwhelmed by all the different investment strategies that are out there, and I didn't know where to start. Then I stumbled upon a book that was so convincing to me that I replicated it almost completely and just personalized it a bit for my needs. This is the book. Unfortunately, I think there's only a German version, but what it basically says is that mutual funds don't outperform the market in the majority of cases, and that is research-backed. Therefore, private investors should invest into low-cost index funds. And he suggests a portfolio that is well diversified over the whole world. Now, we will not go deeper into his specific investment strategy because it involves more than 7 different ETFs. I will do that in a separate video about advanced investment strategies. Here in this video, we will focus on very simple strategies with 1, 2, or 3 different funds so that you can get started right away. Just one quick thing before we dive into the content. I will make the assumption that you already decided on your asset allocation because we are going to talk only about the risky part of your portfolio, not the risk-free part. So let's dive in, and we will start with the one fund version. So that means you only have to decide on one product, and that obviously is very easy and a very simple way and takes the least amount of effort. You still need to be well diversified, and that's why I have 2 examples for indices that both fit that criterion. The first one is the MSCI World ACYIIMI. That stands for All Country World Index, and the IMI stands for Investable Market Index, and that means that small caps are included. Let me explain. So this short form CAP stands for market capitalization, and that is a way to look at a company's value by taking the total value of all of their stocks. And usually when people talk about companies in a certain economy, they will differentiate between large cap, which is the upper 70%, then mid cap, which is the next 15%, then small cap, which is the next 14%, and the last 1% would be micro caps. So this MSCI World All Country World Index actually covers 99% of the market capitalization of the whole world, and it contains over 9,000 different companies. So yeah, there you're basically buying the whole world in one product. An alternative would be the FTSE All World Index. This one covers 90 to 95% of the market capitalization, and it includes around 4,000 companies. So the smaller companies are not included here. So choosing one of those is obviously a great way to buy as much as possible within as little as one product. If you already are at a specific investment company that doesn't offer those 2, there might be other indices with a similar range. Now, if you want to be a little bit more advanced, although advanced here doesn't necessarily mean better performance, but it can, you can also go for a 2-fund version. Here you will buy 2 products, which is still simple, and it allows you to take on a little bit more risk or a little bit less, but this version will also require you to rebalance. So an example here would be the MSCI World. That is an index that covers the Western world or the industrialized world with the biggest market capitalization. So that means small caps here are not included. An alternative index would be the FTSE Developed. And the second fund could be, for example, an index on the emerging markets. There is, for example, the MSCI Emerging Markets that covers the developing world with the biggest market capitalization, or also the MSCI Emerging Markets IMI, which again stands for Investable Market Index. And what it means is that it also concludes large caps, mid caps, and small caps. And then you choose a split between those 2 products, for example, a 70-30 or a 60-40. Now, by putting the developing world into your portfolio, you do take on a little bit more risk. That can lead to a better performance in the future, but theoretically it can also lead to a worse performance in the future. And again, a rebalancing would be needed, or at least advisable. That means if you, for example, decide for a 70-30, but then the MSCI World performs better than the emerging markets, you would need to invest a little bit more into the emerging markets in order to keep the balance which you decided on. The same will apply for the 3-fund version. And one important note here, I don't mean the 3-fund strategy that includes bonds like in the Boglehead strategy. The 3 funds I talk about are all the risky part. And this will again be an index on the developed world, like the MSCI World, an index on the developing world, like the emerging markets. And as 3rd fund, you can either choose a region. For example, when you live in Europe and you're saying, I believe in the European economy and I want to invest in it a little bit more, then you can add, for example, a Euro Stoxx 600 to your mix. Or for that part, any other region that you prefer. For example, you could take a 50-30 and 20 split. So 50% MSCI World, 30% emerging markets, and 20% Europe, or any other region that you prefer. What you also can choose choose for the third fund if you don't want to overrepresent a certain region is you can take small caps, especially when you chose indices for the developing and the developed world that are the highest market capitalization. You can fill the gap with small caps. This will add a little bit more risk to your portfolio, but by that also a potential better performance. Now, which option you choose will depend on the effort that you want to put into it, to research all the different products, and maybe also the money you have available each month. I personally started out with an MSCI World and an MSCI Emerging Markets IMI in a 70-30 split. Later on, I personally decided on a strategy with more ETFs. So at some point I had 7 or 8 ETFs I was regularly investing in. But when I have smaller amounts that I can invest, I would also go for the one fund version just to keep the costs low, especially right now where I'm at a broker that has a cost per order. So know that you can adapt the strategy anytime. You can start with one or you can start with two and then later on switch to 3 or more, or you can also just stick with it. You can also personalize it. For example, if you only want to invest into socially responsible companies, there are also specific indices for that. By the way, if you switch strategies, that doesn't mean that you have to sell the old stuff. You can keep all of them and let it compound over time. If you're now wondering why I haven't covered bonds in this video, you will find the answer right here. Thank you for watching and I hopefully see you in the next video. Bye bye.